Welcome to the Physician Sense Podcast, a podcast designed specifically for physicians, offering a breakdown of complex financial topics to help you develop your financial IQ, further your financial journey, and improve your well-being. Whether you're a medical student, resident, fellow, or attending physician, you're sure to learn something new that will benefit your journey. And now, your hosts, Chad Chubb and Tyler Olson.
And welcome to another episode of the Physician Sense Podcast. Thank you for joining us. I have my fabulous co-host, the one, the only Tyler Olson, and we have a fantastic topic, a topic that gets a lot of questions, and we're going to add two layers to it. The first topic is moonlighting. But as Tyler and I are talking through moonlighting, we say, well, most of these things also apply to anyone that's looking for side gigs. So in today's conversation, we're going to talk through moonlighting and side gigs, things you should be keeping in mind, and not just in terms of taking on these new roles, right? But also in terms of taxes and investing, even in insurance. So we're going to walk through a lot of those great, very important details if you are an individual kind of contemplating moonlighting or adding a side gig in here. Tyler, thank you. As always, welcome, my friend. Where do you want to start today? What do you think is the best way to introduce a physician to financial planning in terms of, hey, I just took on this moonlighting gig. I just took on this side gig. Where are you usually starting when you're having conversations with any other physicians that you're chatting with?
Taxes. Taxes is always the first thing that comes to my mind, because the reason that someone in training may take up the opportunity to moonlight is because they can go from making like $15 an hour to, I don't know, 6-8 times that with moonlighting. And obviously they want to take up that opportunity with the skills that they've developed. Someone that is out of training and they would like to supplement their income with some side consulting work, expert witness testimony work, medical record review. There's a lot of different things that, that they could do. It's always about like, well, I want to make some extra money. And so then they look at the dollar amount, and it's important right away to say to yourself, nope, it's not that much. It's less than that, because we got to set aside the money for taxes. But I'm glad you mentioned the importance of looking at investment opportunities as well as, protecting themselves with the right insurance for whatever they happen to be doing. But first is taxes to me, because if we don't get that right at the outset, they've got a big tax bill to pay, and that's very frustrating and demoralizing. And I don't know, like, what do you think about, the amount to set aside? I've oscillated a little bit on like what percentage to say publicly, because it's, varies so much, but I like to say 30% for those who are in training. And then I like to say 40% for those who are out of training. What do you think?
Yeah, I think that's a fair number. I think we usually will start at 30. But like you said, it's hard giving those like, hey, what's my savings ratio? It's hard to give that broad stroke of the brush. And it's one of those topics where I'd probably rather have you saving too much than not enough. So I think 30 to 40 is a fair range. But more importantly, before we jump over on what taxes mean, why don't you also give us the description of almost the way of paying taxes, right? So if you're not familiar with the term quarterly taxes or quarterly estimates, this could be a whole new ballpark, depending on what your 1099 income is, which we're assuming this is a 1099 moonlighting or a side gig. Some of those could clearly come into the W-2 side, but let's just assume it's 1099. If it's a smaller amount, maybe you're adjusting your W-4. But when you have someone, Tyler, that you're working with, and they introduce this new level of income, let's just say we're on the same page. It's somewhere to 30 to 40%. But now explain the process of actually paying taxes will actually play out.
So we have to organize the cash flow. So say you get paid once a month for your moonlighting work. And say you start in July this summer. You're like, I'm starting this month in July, and I'm going to get paid August 15th for the work that I did in July. And let's say you made $2,000. Say you're in training. So you did some moonlighting, you made $2,000. What you're going to do, or what I would suggest doing, is that $2,000, it comes and it hits your checking account, and immediately we're going to take $600 or 30% of that, and we're going to move it to a separate savings account, like a high yield savings like Ally or Wealthfront. And you can create a category for estimated taxes. Now, personally, I like to break it down even further. I have 4 buckets. I have Q1, Q2, Q3, and Q4. Quarter one is what I mean by that. So because you have to pay 4 times per year when you are making money that is not automatically having taxes withheld from it. Now, let me explain why. If you're an employee and you get a paycheck, your employer uses their payroll system to automatically send your taxes to the IRS and to your state revenue department if you live in a state that charges income tax. So you don't have to do anything except when you file your taxes in the spring. But if you earn moonlighting income, and this is with the assumption that it is not being funneled through your program's payroll system. Some residents can get their moonlighting done through their program, and that's great if they're doing that, because then you're not having to do this. But assuming you are getting money directly and you are having to set aside money because this is 1099 income, you are responsible for paying taxes 4 times per year in most of these cases. So if you make $2,000 in July, you get paid in August, you got to take 30% of that, put it into your either quarter 3 or just estimated taxes savings bucket and leave it in there. And then come September 15th, that is when you have to pay quarter 3 taxes. And that is the routine. Every time you get a paycheck that has not been taxed, you got to take 30%, put it into the tax savings account, and then that money is there for you to make your estimated taxes on the due date. The due dates, one of them is weird because I really don't know why, but there are 4 payments. There's April 15th. That's quarter 1. So income that is made January, February, and March, you have to pay April 15th. It is the same day as when your federal tax return is due from the previous tax year. And so you may have taxes that you have to pay from the last year, as well as estimated taxes for this current quarter. So it can be a heavy payment date, right? Actually, I had a good, well, it's not a good, it's good if you're paying taxes, it's good because you're making money. But man, I had one of those payments recently and bam, that was rough, but it's reality.
It's a painful day.
Yeah. But then quarter 2 is not 3 months. It's 2 months. Don't ask me why. April and May income is due on June 15th. And then June, July, and August income is due September 15th. And then September, October, November, December, so 4 months of income, is due on January 15th of the following year. And so you have to get into like a good pace of setting aside the taxes and then making the payments to both the IRS. Well, I think it's irs.gov/payment is the website. I mean, you could easily find it. If you just Google, I need to pay the IRS online, and you can even pay with a credit card. And if you got like a cash rewards, I know this is, sorry, the segue. If you get like 2% back, a lot of these payment processors, they charge like 1.7, 1.8%. So you can make a little bit of money there, but I'm not recommending anybody put their estimated taxes on a credit card. But yeah, irs.gov. And then if if the state you live in charges income tax, they also all have online payment systems. And so you just want to make those payments on those dates.
If you're sitting there thinking, oh, I'll just game the system, Tyler. I'll just pay everything in January. Why is that a bad idea?
You mean make all the payments for the whole year?
Yeah. So let's just say you had 1099 income all through the year and you're like, well, you know what? I'm not doing April. I'm not doing June. I'm not doing September. I'll just catch up in January. Tell them what they want if they do that.
Well, they will know when you paid them and you'll pay penalties and interest. And the interest has gone up on late payments. Yeah. What is it, like 8?
What is it? It's 8 now because it's linked to the 10-year treasury is where they usually get I think that's how it works. But yeah, it's 8% right now. But it used to be 3% last year. So that just goes to show you how quickly it literally skyrocketed. But that's the reason why I kind of threw it out there in like a game show fashion, is because we'll have clients say that sometimes, like, well, I'll just wait till January, then I'll catch up there. But they're taking, there's an actual tax form. I don't know the exact tax form number, but they'll show you like the weighted number that you owed throughout there. So even though you paid your entire tax bill due by January, because you did not have those equally distributed through the other 3 quarters that you were earning money but not paying Uncle Sam does not like that. And he will add penalties in there. And I'm somewhat shocked, even if we take out 1099 income, but even, on W-4 pays or W-4 updates in terms of coming through your W-2, how many times we do still see underpayment penalties on new clients that join us. And then when we bring that to their attention, they're like, wait, what? I was paying penalties? No one ever mentioned that to me. So just keep an eye on that. It's not as common with pure W-2 because you usually hit a pretty good rhythm, but the 1099 income, an easy spot for you to start seeing that underpayment penalty pop up there.
Yeah. No, it's important to follow these guidelines
and
what extra cost. Otherwise, you're just going backwards.
Tyler, when physicians are paid 1099 income, I always say, I feel like the broad stroke of the brush is you should always be paid more, but tell them one of the main reasons why they should be getting paid more in terms of taxes. And just so I'm not like keeping the whole board open to you, in terms of FICA taxes.
Right.
More with 1099.
Right. So in an employee role, you are liable for only half of the Social Security and Medicare taxes that are due. Your employer pays the other half, the other 7.65%. But as a subcontractor in that role, you are responsible for all 15.3% of the Social Security tax. So it's important to make sure that your compensation, and this particularly is relevant for those of you not just doing, moonlighting, but even more so for those of you pursuing side consulting work of some kind. And this is really relevant too for those of you that are being offered like full-time 1099 work. Like some docs, their employees, and they're like, oh, we're going to transition you to a subcontractor role. Your tax liability is going to go up. And you want to make sure that your compensation reflects that, because that employer is no longer responsible for that tax. You are. So 7.65% extra in taxes up to like $150,000 of your income, not to mention other things like administrative work, accounting, extra tax work. You should definitely be paid significantly more on 1099 income versus W-2 income, all other things being equal.
Yeah. I mean, and let's just like build a little bit on that full 1099 role is, don't forget too, there's no more group life insurance. There's no more group disability. There's no more group health insurance. You will tell everyone, like, the biggest shock to most first-time entrepreneurs is buying health insurance, right? That is such a huge premium these days, and that can be a shock to the system. So all good things to keep in mind, but this is also why if you are going 1099, really in any capacity, whether it's full-time or, a side gig part-time, you should be getting compensated more. Even if we kept it as simple as you just paying Uncle Sam that extra, 7 and change. And your state's also important here. I feel like as planners, we usually focus on the federal, at least in a broad, podcast, YouTube channel, because that's the one thing that's consistent for all of us. But, your state is really important here. If you're 1099 side gig in California versus Florida, there's a big difference there. Or a New York versus a Texas, there's a big difference there in your taxes. And be aware of these things. Working with a good advisor, working with a good accountant, you'll be able to fine tune those. And, even if it is W-2, like, don't forget, I'm always shocked by this one too, Tyler, on, whether you're getting a large refund or you're owing a large tax bill every year, don't forget, you can adjust your W-4. You can really customize that thing. You can fine tune it literally to a dollar amount. So just as we're talking through new income coming in and taxes in particular, good things to keep in mind. Tyler, I have 1099 income now. I'm paying Uncle Sam. I got my 4 dates listed. What is one unique investment vehicle I can now utilize because I have 1099 income? And again, emphasizing 1099 income because, as Tyler noted, there are a lot of programs where you can moonlight and just coming through your traditional W-2 pay through the current hospital. But let's assume, again, all 1099. What other opportunities have opened up now in the investment world for me?
You can invest in either a single, or I guess we call it a solo 401k, or a SEP IRA. both of those retirement account types allow you to take a tax deduction on the contribution and get the money invested. So there are some subtle differences in those two account types. The SEP IRA is much simpler. The solo 401k is more complex, but you might be able to set aside more money into it, depending on what your total 1099 income is from that source. So I tend to, for those who are working, who are just doing stuff on their own, I tend to tell them to do the SEP IRA and forget about the backdoor Roth for now. Or, if they're going to work with an advisor, then you can get a little bit more fancy with the solo 401k. I just find that people make mistakes with solo 401ks sometimes, and the net benefit of it may not be that much better than the SEP, because like with the solo, you can do, it also depends on like what retirement plans are being offered through your employer. So there's some variability there. But those two account types are both available to someone that's doing side work. I got a question for you though.
Mm-hmm.
With the SEP IRA, the business owner, can they put 20 or 25% of their net income into the SEP?
20.
All right.
I don't know where it's funny because I had a client push back on this once, and I actually had a hard time like finding an IRS that just said it was 20. I don't know why that 25 is quoted so often, but like
the employers,
it's heavy out there.
Employers can do 25% of employees' compensation.
Yeah, I guess maybe because we're so used to like the 1099 side. Like it's like one of those ones where like no one's ever pushed back. I've always just said it's 20, and then someone was like, "Can you show me that?" I was like, "Yeah, I don't know why I'm having such a." I found it, but it was like harder. I thought it'd be like one Google search. I sent him a screenshot, but like it took a little bit. I was like, "Oh boy," it's funny because I would actually say I'm almost the opposite of that description of the SEP IRA versus solo K. I usually always default to the solo K. Now, I think solo Ks have come a long way in a short period of time. Oddly enough, pretty big breaking news last week that Vanguard is going to leave the solo K space. I believe it's Accent is going to come in and kind of take over that space. So that's kind of big news. But like to open up a solo K and a Fidelity, a Schwab is pretty easy on the cookie cutter model. You can customize them, and that's where I think you can get complicated. When you go over $250,000, it brings in the Form 5500. It adds some layers to it. Once you get that Form 5500, we always say, like, you should not be listing your Social Security on that anymore. You want to certainly have an EIN number by that point. But my theory has always been that whether you do the backdoor Roth or not, I just don't want the SEP or the one that no one ever talks about anymore. The simple IRA is technically out there for you, but it doesn't get any love anymore. So we usually will default to the solo K. But I also think it depends. We're talking about moonlighting and side gigs here. There's a chance that you're still under the income limits that you don't even have to do a backdoor Roth. You might be still going directly to a Roth, or in that case, the SEP is a little bit easier. The SEP was more popular pre-COVID, in my opinion, because of the solo K always had that hard 1231 stop, where they've added a little bit more flexibility in there now, where you can still get the employer portion in as opposed to the employee. So there's a lot of moving parts there, but I think the main takeaway is if you're an individual who now has a form of 1099 income, you do have a new investment island available to you. And whether you're going to do that as a solo K or a SEP IRA, or maybe you're a wild one and you end up throwing a simple IRA in there, the only two downsides to the SEP and the simple are it would block, I won't even say block, it just adds in the pro rata issue to your backdoor Roth, which essentially ends up not making it very attractive to do backdoor Roths at that point.
Mm-hmm. Yeah. So when you say that your default is to do the solo K, is that under the arrangement where you are working with them?
No. Now, in defense of that, the clients that come to us for a one-time plan usually have pretty good financial IQ, right? They're not coming to us asking us, what is this solo 401k, right? They're already comfortable investing. And no matter how easy I make investing sound, and I tell everyone this, if you've ever done a prospect call, I always describe it the same way. Everyone gets terrified of investment management, even though today it is more simple than it ever has been. But if you're comfortable doing that, we would still say, open up the solo K on your own. And I just think it's come such a long way that you can still have a solo K opened up at Fidelity in a few clicks. So that's why we've always defaulted to that. Whether it's ongoing or not, obviously ongoing, it's much easier. We're like, hey, we'll sign the DocuSign and then we take care of everything for you, compared to like, hey, we're going to give you the playbook. You got to put it in play. But if you're already comfortable managing investments, the solo K really shouldn't add anything new or anything more complicated to your financial playbook there.
Yeah. Well, I'm glad you shared that because I could tune up my optimism toward the ease of DIYers just setting up their own solo 401k. Because, yeah, it is a bit annoying if you have to move the SEP over to a future employer's 403b or whatever. Yeah.
And one of the hacks that we like too, Tyler, just because when we bring up 1099 income, not as common today, but a few years ago, we get into these spots where clients had these IRA balances. We would always tell them to go take online surveys to create at least $600 of 1099 income so that we could just go open up a solo K somewhere, consolidate some of those older IRAs, and then they could start to do backdoor Roths. So I think that's another unique thing about 1099 income. Even if you're not going to have it forever going forward, it might give you a unique spot to get some IRAs consolidated in there, assuming for some reason your current 401k plan didn't make sense. As I preach on all these, I'm a big fan of simplicity. We tell clients all the time, keep their TSP. We love the TSP. Great place to consolidate older accounts, low cost, easy, not overly complicated investment options. And I think when you get that 1099 income, a solo K does give you a little bit of an opportunity as well to at least have a parking spot, whether that's for a few years or it's for a few decades. It opens up that route, at least at this point.
Yeah. It's good to take advantage of some of these things. And if you do that too, then you're supplementing your retirement savings. If you're in training and you're doing this, you're creating investment opportunity earlier on, and time invested is super important. And then it just all stacks on top of each other over time. So you want to take full advantage of this. Now, the issue of insurance, that varies, right? Like I have a conversation with two different docs in the last couple of weeks about them taking on just some like side work, and they're trying to figure out liability. And, the question they asked was, can I just run this under my own social security number, or should I set up an LLC? And if they're totally out there on their own, their employer's, group liability coverage has no relevance. So I tend to say, probably a good idea if you think that you're exposed to some sort of liability risk here, probably a good idea to get an LLC. Do you agree?
Yeah. I feel like a lot of times the misconceptions with LLCs are that they assume that gives you like this get out of jail free card, where a lot of times it's keeping things organized and tidied. Even if you go open up an LLC and you still have a medical malpractice lawsuit, whatever assets aren't saved, that LLC is not going to safeguard you in that example. Usually we'll tell our clients, if you're going to go get this 1099 income, this side gig, the main goal would be, it just allows you to have an official entity in place. So it keeps you more organized. You feel like a business, like a true business per se, and having that separate EIN number, that's usually the main benefits we'll describe from it. Where again, sometimes I feel like, and we even use the term, LLC it, anything that's a risk, LLC it. But you also need to be aware it's not this get out of jail free card. So we kind of always add that little asterisk in there.
Yeah, no, that's a good point. Are there any other insurance issues that should be considered?
I just, before we jumped on here, the one that I always say this, but we've never seen it in practice yet, but always make sure that your medical malpractice insurance is covering that side gig, right? If it's run right through the hospital, right? You're just doing moonlighting, we're not concerned there, right? But if you're your traditional W-2 physician, but you are doing something off to the side, just make sure that your medical malpractice will still cover that. Again, we mentioned this. We've had clients consult with medical attorneys and they're like, no, you're good. So I've never seen an example to give you to say like, oh, actually, here's a perfect example where it didn't cover, but just little things, make sure that's covered. But that's one that we usually will have a conversation on, or at least put as a bullet point when physicians are adding on this next layer of income.
Yeah, I agree. I think it's a good learning experience too. Like obviously, aside from the extra income and the investment opportunities that are afforded because of this, I think it's a great learning experience to be able to appreciate the challenges of entrepreneurship, from like, even from just like a small perspective. And like, I meet more and more docs that are interested in expanding that, where they can do things on their own, starting their own practice, or doing something else just to supplement their primary clinical work but on a regular basis. And if you start small and you can kind of see how the parts work, it's like once you get past that, then it doesn't feel so scary. It doesn't feel like I could not do this. I kind of compare it to like doing the backdoor Roth, although I think the backdoor Roth is far easier. But, like when you first look at it, you think like, oh, this thing, I don't know how to do this thing. But then after you learn how to do it, then you feel confident. And I feel the same way, the same thing can be achieved by going about this moonlighting side gig income management project. You know what I mean?
Yeah. I think the physician community, they always love that other income stream. And this is one where I consider, investing in yourself. And whether this is always just a side gig or it turns out that you can go create your own business, I think it's something to always look into. And worst case scenario, you dip your toe into it, you don't like it. At least you know, right? But I think the moonlighting, the side gigs, any other forms of income as a physician or any high income professional, anyone, it's not a bad thing, right? You want to have those different streams of income, even if it's just to diversify your day, right? Change it up a little bit. So, I think this is an awesome topic with the moonlighting, the side gigs. I think there's a topic too where there's a lot of questions. So if you're watching this or listening to this and you have questions, again, either drop us comments or head over to the website, physiciansense.com, and then drop us a note in there too as we continue to build out these topics here. We know that this is a really popular one and we were excited to get into it. Tyler, any parting words for our moonlighting side gig physicians?
Don't work too much. Live your life.
The work-life balance. We're going to end on that. I'm going to call it a mic drop. But that you couldn't have said that better, understanding the balance in there. So thanks again for tuning in for this episode of Physician Sense. Like I said, if you have questions or comments from this episode or what you want to see in future episodes, drop us a note. But thanks again for hanging out with us for a bit, and I'll see you on the next one, Tyler.
Yep, sounds good, Chad. See you around.
This information is for general purposes only. This information is not intended to be a substitute for specific professional, financial, or tax advice, as individual concerns vary. Please see a financial professional, CPA, and/or an attorney in regards to your own individual situation. Wealth Heals Advisory Services and Financial Planning offered through Vicus Capital Inc., a federally registered investment advisor. Olson Consulting LLC, offering advisory services and financial planning, is a state registered investment advisor.